Good morning, everyone. And today is we are starting the bookkeeping training. It was a big dilemma for me where to start, but I would like to start with something very useful information for you. Today, I'm going to talk about important reports we are working with, how to read them, and how to get them right, and what's the relationship between the financial reports we are using. You're gonna start to learn how what's included in a profit and loss, what's debit and credit in profit and loss, and what's included in a balance sheet, and what is debit and a credit in a balance sheet, and how the accounting formula works. Then we'll look up trial balance, where I try to teach you how to read a trial balance and to detect what can be wrong in them. But in deeper details, we're going to enter trial balance in deeper details as we go along. I would like you to develop an analytical mind when reading these reports and to understand them properly, because only then you can get them right when we work together on the files. And so you're going to become a specialist, so you're not going to miss things, and you're going to understand why is this, why is that. Now, here at the moment, I have a complex, this is a trust um, profit and loss. Now, what we are interested in today, it is the profit and loss balance sheet, and we'll look at the trial balance and why it's important. So these are the main reports we're working with. Xero has many others, and we'll learn about them. Management reports, how to generate financials for clients at the end year, and they also have. When you go to Xero, look up the new reports. The new reports also includes now a cash flow. So, but today we're working with the basic ones, profit and loss balance sheet, trial balance. Okay, so now here I have a trust which I prepared, and then we assume that everything is correct and I balance everything. So this is my work. Hopefully, yes, it's all good. What we analyzing. So when we extract uh, report in Xero, we have to make sure that the dates are correct. We can compare them with previous years, previous periods. And if we work with business with a turnover less than 2 million, then we always extract cash basis reports. we, um, we do not seek to work with accruals. I don't know, you might find that some clients they report on you have to really analyze the best, because some clients by mistake they might report in accrual basis on GST, and that makes it difficult. If they did set up their GST on accrual basis, or and you think that they should be on cash basis, now please advise the client that someone in the past set it up incorrectly, and then just bring them back to cash basis. Because if their turnover is less than 2 million, this is a small business concession rule, and should be taken up. What do I mean? Cash basis. Cash basis is only the money which they were actually paid, and the money which they actually were received during this period. We are not counting for invoices issued and unpaid, because we believe that the client shouldn't pay tax on some money which didn't come in. So let's ignore the invoices and stuff at this stage. Now, let's go. First, on the profit and loss, we're going to see income. Income is always a credit for us. Now, the trading account, which we call stock and purchases and closing stock, this we call it a trading account. Not every business has stock, and even this business, there is another concession for small business that if the stock doesn't move um, with more than $5,000 from 1 year to another, then we can advise the client, do not record stock because this becomes irrelevant this in our profit and loss and taxation office, so we are allowed to ignore it. This client of mine, he likes to record his stock. Maybe just got used to it before the small business concessions came in. But it is not big movement between the stock. Even if they count for it, they don't have to appear in here unless they actually want to see it. And client can choose. And then we can only advise them, but if they choose to actually record it, that's fine. So now, opening stock, it is the figure from the closing stock last year. So that's how it works. And now we make purchases against the stock. And then we end up with a closing stock. Closing stock is a credit against. So that's how a trading account works. Plus, 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 minus. And then we come up with a cost of sales figure. Gross profit becomes, yes, income less direct expenses, which this cost of sales, we call it, comes against the income. So this becomes a gross profit. Other businesses like, let's say, contractors, like construction industry and stuff like that, they will have different things, materials, for example, against the sales. So whatever is a direct expense to income becomes cost of sales. That's how you have to look at it. And after this, we gross profit figure. So then it's income less cost of sales, gross profit. Now, to end up with net profit, we have operating expenses. These expenses are necessary to spend while operating the business. And we can see these headings. And yes, these are day-to-day expenses in order to keep the business going, including the wages. All right, so these are debit. Again, all expenses are debit. Income is credit. This is debit, 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 credit. And we'll come back to closing stock because this closing stock figure also appears in the balance sheet. But we'll come back to this relationship later. So now expenses are all debit. Now when you see a bracket here in this report, meaning that is a minus, you have to analyze that figure because something went wrong in the expenses. They should be debit. They shouldn't be in credit unless some refunds happen and put the accounting credit, but we don't like credits on the expenses. They all should be debit here nicely without brackets. Okay, so we analyze this, what's debit credit. Now the balance sheet is harder to read because let's pull a balance sheet with comparatives here. I have to work with, sorry, but I have to work with a real client because the demo company doesn't give us enough material to learn from. Okay, so what we want to do, it is July 14. no, balance date is June 30, because here he's asking you for a balance date, not the period. All right, so is June 15. And then we can compare it with previous year. That again, here you can take cash basis. Let's don't worry about and update this. Now, here we can see brackets and all that, and they all appear to be in one side, debit, credit, so it's very hard to read this, but this is where we start to learn how to read this. Now, assets are always debit, including cash at bank, cash on hand, debtors, trading account, whatever it is, other assets the business has. Stock on hand. Now, when I said relationship between the profit and loss and balance sheet, now when I said the closing stock from profit and loss becomes stock on hand in the balance sheet, this figure. And if this entry, when we have a trading account in the profit and loss and this entry is not appears in the balance sheet, is something wrong. You have to go and why don't we have this figure in the balance sheet? We have to reconstruct the whole thing. All right, as we said, assets should be debit, but there's interesting things happening in here. The actual asset is a debit. When we go accumulated depreciation on building, this is write-offs, like building write-offs from the quantity surveyors report. Now, we can depreciate buildings and we can depreciate fittings, fixtures, and whatever they belong to the buildings that we're going to learn about this later. But this particular business has a few properties. Now, when we go less accumulated depreciation on any asset, this comes up with a minus. This is a credit. This goes against the asset we're depreciating, so the asset diminishes in value, and means that we call this. Why is in an asset area? Why didn't we shift it to liabilities? Because we actually want to see this nicely related to each other. So, and then this one becomes something we call a negative asset entry. This is a positive asset, this is a debit, this is a credit, and that's why it's in brackets. Different systems, they report differently. But normally what is in brackets looks to us as a minus, and we always have to know why. Same again, so don't forget this is called a negative asset account once it's in an asset area. Now, accumulated depreciation is allowed to come up with a minus in an asset area, but not much else. If you see a minus in the asset area, let's accept the depreciation lines, you will have to analyze that because it means something went wrong. Assets, they have to be debits at all times, and just the depreciation to go against it with a minus. Let's see here. Motor vehicles, less depreciation. General pool, looks like now it was all depreciated, so but we still record it. We leave it in the nicely, so we actually know how many assets we got in the books are depreciated, but we still held them. What else I wanted to say here was that yeah, with a general pool. Now, in the past, you're gonna find some clients come to you from previous accountants, or you pick up a job, and so they have all kinds of pools, low value pool, long life pool, general pool, this and that. They might have a few pools recorded, but we tend to then analyze that asset register. We have to ask for details from them. We analyze that asset register and we group them in one pool only. This is the new rules. We don't need to have 17 pooled assets. We can group them in one, and I encourage you to do that. It is a hard story for us if previous accountants who worked on the file didn't do it, but we tend to do it. And I expect you to actually somehow sort that out. When I only want to see one general pool in here. General pool depreciates at 30%, and additions to the pool depreciate at 15%. Additions during the year, it doesn't matter the date. And disposals the same, like we depreciate at 15. Now, we will have a complete separate session on the depreciation figures and how the depreciation rules they changed in the last 2 or 3 years, and it is a big confusion there. But we will dissect all those rules and we will learn about them according to the dates when the legislation came in. That's a separate that's a complete separate session for us, but just for you to understand in general what the pool wants to do here. All right, so now we finish with assets. We believe they all should be debits. Even I've seen cash at bank when it's in credit, it means that the bank was overdrawn. Only then the cash at bank is credit with brackets here. If the bank wasn't overdrawn, then we got a problem. We have to go back and start to balance the bank. Credit cards are normally picked up here, but you can choose. You can choose to set up a credit card, but we'll talk about this next week. You can choose to set up a credit card grouped with a bank accounts, but that one will be minus. That one is going to have a credit balance. I suggest to set up, because it's 2 ways to set up a credit card. We'll see it next week. We suggest to set it up in the liabilities area. But it's up to you, but as long as you can read it and why it's there. Now, the liabilities, we can see that liabilities, they don't appear in credits here. But this is just a conventional report. They should be credits, yes. They are all credits. And that's how we read the report. Even we don't have the brackets there, but that's how they don't want to put brackets all over. That's how the system reports it. But that's why I'm saying it's confusing, because even if we don't have brackets here, how can I say, suggesting a credit, these are all credits. And it is grouped current liabilities, non-current. So I'll talk to you about this. Current liabilities refer to assets which can be, how can I say, can be transformed in cash, or they relate to this particular financial year. They should be paid out this year. Non-current liabilities, they refer to longer term liabilities, and they will be paid in future years. But these ones to be paid this year, these are the current liabilities of the entity which should be repaid this year. Now, here with what I got here, which looks a bit strange to become a current liability, we can choose to make it current or non-current, but these are the loans, these are the beneficiaries' loans, how they accumulated over the years at the movement. These are, because all these loans are in credit, meaning that the owners, they kept putting money in the business or kept buying assets with their own money, you know, and supporting the business assets or business operations. Even when I say current liability and should be repaid this year, is not, these are just entries to the loans, and they will not be repaid this year. But when the business gets sold, they have a significant role when we value the business at the time and who gets what. So they've been recorded like this, we leave them like that, not necessarily. And in the case of a company, director's loan also should be a current liability in our mind, should be repaid that year or not that year, but that's a different area, and that's a higher advanced accounting for us. The director's loan is, we'll talk about it later. All right, so current, so how do you understand that? Like GST, for example, it is a current liability because it's due now. It shouldn't be there for longer than this year, 1 year. It has to be paid immediately. Creditors, we expect the creditors. Yeah, so to be paid as soon as possible. Okay, so non-current liabilities, we got loans for some assets, loans for buildings, and that's where it comes. Here we record because we took a loan. This is the loan against the excavator. And then we record the interest against it, and interest hits, this interest figure hits the profit and loss. Yeah, so we'll learn about how to make entries against loans and finance a bit later. Now, what the interesting part is equity. So now, when you learn assets minus liabilities equals owner's equity. Now, this one equals this one, and that's the accounting formula. Now I want to show you how and why it does work, because what do you think that, how do we get to the $10 to match this? Don't forget, this is a trust. Current year earnings 75,000. It is the profit of this year, and I should have left the profit and loss open for you to see. Let's open a new tab. Zero, you can open in new tab different things, so we don't lose this, so I can actually flick through it and show you. And we have to pick up a date range. Now you have a chance to have a look. Yeah, I think, yeah, 1st of July to 30 June 15. and they got shortcuts how to find the date in Xero, but I never accomplished them yet, but I just do the normal ways. And don't forget, let's do cash basis and update this. This is going to bring us competitive just the way we've been. Now let's have a look. 75 and balance sheet 75, yeah? That's how we read it. And at the end of the day, this has to equal this. Why do we have a contra entry here? Because the trust distributes all the profits to their beneficiaries. We don't retain earnings. We take it out and distribute it to the beneficiaries. According to the agreement, what was the agreement, who gets how much percentage, according to the percentage what the client advised us to distribute. So that's why we don't, companies can retain earnings, and that's when more mess comes up in here. But well, if you struggling or if you think that is something wrong with the balance sheet, we'll discuss it and you learn a bit more the specific job we're working on. And yes, now if it's something still not clear, so then I got a tick. And well, again, we have to really have a look at the date. So sometimes you get scared, oh, what's my trial balance, but maybe the date is not correct, you know. Sort by account name or account code, like you can come up with codes, your choice how you want to report this. Now, I just don't know why the system always gives us, and same is in my system gives us the movement in the last month, and then we got, it's a bit confusing for you that when we want the yearly trial balance, we have to ignore this. I don't know why. Picks up the very month which we report on, and then this is year to date. We actually want to have the report at the end of the year at the moment. I mean, when you want to report for the month, that's one thing, but see, trial balance is the movement from last year to this year to come up with whatever. So these are the entries which they moved the last year balances to this year. And again, let's have a look what's in credit, the revenues. And let's see, where does it pick up the trading account? I think here puts it all in one and doesn't pick up, so opening, so it just consolidated it in one line here. It is up to the accounting system how it reports for it, but it is a debit at the moment, and the equivalent in credit is in the balance sheet. Okay, so let's go. Expenses nicely picked up in debits. And the closing stock, yeah, it did pick up the closing stock. So I was looking for that one. Very good. And closing stock is in credit. Okay, so buildings again. See how nicely we can see debit, credit, debit, credit. This is a bit more obvious than the balance sheet where you have the negative asset on the debit, credit. This is more obvious. What I suggest that if you really want to see only this year's and not the month, and analyze it from there, we can export it to an Excel and then just delete these two columns. Yeah, I think Xero came up with more flexible reporting lately, and there's videos to be watched, and I'm gonna just find them for you because I just watched one the other day where they included columns. You can include columns or delete columns from the report the way you want to see it. They improved it. It's a matter of fact for us to learn it, learn all the innovation what Xero does. All right, so it is obvious now. Assets go debit, but only what I said goes credit. The depreciation ones. And that's why I said that reading the trial balance is more obvious, and you can find the mistakes easier from a trial balance when you read this. Trial balance, it is the whole activity of the business during the year in one report. And again, accounting, because we have a double entry accounting, debits will have credits will have to match debits, and we have to have debits equal credits because of double entry system. Everything comes in has a contra entry in credit, so any debit has a contra entry in credit somewhere, somehow, in some account. We can't just lose an entry and never follow it up on the other side. So our trial balance has to balance. And if it doesn't, it is a big, big problem. Normally, Xero doesn't allow you for that much error. Other systems, they do. And you're going to see when we start to learn how when we transfer trial balance from other systems to Xero, there is a room for errors because it is our entry. It is our work coming in as a journal here. But that's we're going to learn it the next couple of sessions, how to transfer the trial balance. That's a very complex procedure, but you're going to be very proud if you accomplish it. And I'm going to insist on it. And probably we're going to come back 2 or 3 times to that, just to repeat the procedure and find things which we didn't accomplish earlier, and to perfect this procedure, because I think I discovered the best way to transfer trial balance from other systems here. And other accounting practices, they just didn't even think about that. And I talked to a few accountants, and they've been surprised that I discovered this method, how to actually transfer a trial balance from another system to Xero. What do I mean? So then we can issue financials according to that trial balance. Others, they didn't figure it out. Others, they don't want to use Xero because if the ledger, the complete ledger is not in Xero, then they don't want to touch it. They don't know how to go around it. But you and with us, you're going to learn that trick, and which is still a mystery to others. Okay, so then you're going to also understand why we're doing that and how good is that. So trial balance has to balance. This reflects entries, debit, credit. Something here has an equivalent somewhere. And that's the story that when we do journal entries or we do stuff, we actually journalize it to the right account, and we don't make mess around here. Journal entries, yes. I'll teach you more about that, but journal entries, they have their own meaning, but we shouldn't abuse journal entries to do interesting entries to hide things somewhere, trying to hide it in all kinds of interesting accounts, because I'm coming and I'll find them for you, all of them, and you will have to redo them, or you will have to explain it to them, why did you do that, and then I'm going to explain it to you why I was wrong and where should I have gone. So we will always have to learn where the entries go, and we will learn to analyze a trial balance, a messy one, and then I'll ask you to identify what could go wrong in here, and then we start to analyze it. I had very interesting ones to do, and I want you to develop an analytical mind when analyzing these reports, to realize what could go wrong, why did it go wrong, and how to correct it. And that's that gives you the skills which probably others they don't have, because once you analyze a trial balance, and you should be able to detect the errors in it, or what it might be wrong, something, to have the eye for it, that this one is just doesn't look quite right. Let's see and investigate what happens there. So trial balance. We work with trial balance, and trial balance then is dissected into the balance sheet and to the profit and loss. We are going to find the same figures here. Trial balance is a sum of all transactions which they match. Profit and loss. So financial position, financial performance, financial position, how many assets and how many liabilities we got, and how they relate to each other. So now with this, my elaboration about what's debit, what's credit, and what reports we are working with, and how to read it, think about it, how they relate to each other. And when courses in bookkeeping, they teach you that the accounting formula, yes, but you actually have to realize why it's working like that, how it's working, and how important it is to understand the accounting formula they want to come up with, plus the double entry accounting. So I hope I didn't start this course a bit too deep for you, but I'm sure that anyone has to be able to read profit and loss, balance sheet, and how they relate to each other, and the trial balance. So we'll